Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. I'm really pleased to welcome to the microphone this week for the very first time, I have Victor Lagos from Lagos Financial. Did I pronounce that correct, Victor?
It was close. It's Victor Lagos.
Lagos.
Yes.
I should be innocent of this because I come from Italian background, so I should have checked before we actually came on air. I apologize. Lagos. Okay.
Lagos.
Now, Victor comes to us with a background as a mortgage broker. He's the holder of an Australian credit license. And like we always do, ladies and gents, on Dollars Making Sense, I make sure that people that come onto the show are licensed to actually talk about what they talk about. We don't like finfluencers and the like that, they read Money Smart and all of a sudden they're an overnight expert. But look, Victor's been doing this since age 19, my word. It's nice to know that you started young, Victor, in that regard. And Victor's expertise lies within residential and commercial property finance. Now, today, Victor, I've asked you on the show, and I think one of the things that really I'd like talking to people about is debt. I actually invest in debt, but we're not here to talk about me. I like to talk to people about debt because my kids sometimes come to me and they don't understand how money can cost different amounts, but it actually does, doesn't it? Money can cost a lot, or it can be, I guess, cheaper than usual. There's a difference between good debt and bad debt, isn't there?
Yeah, exactly. And a lot of the time people don't realize this until their later stage in life when they've borrowed money, paid it back with interest, and used debt for their own benefit. So I've learned through personal experience and professional experience. So I really love to share that.
Wonderful. So I guess like all of us that have been around the traps a little, and you get a few wrinkles and a bit of grey hair or hair that's just disappearing these days, I guess. But I think one of the things, do you tend to learn from good experiences or bad experiences in your time, Victor?
Bit of both, actually. I mean, you mentioned earlier that I've been in the game since I was 19. To give you some context, I'm 37 now, so that's 18 and 19.
Oh, so old.
Yeah, but I'll tell you what, though, people get onto the debt bandwagon pretty early these days with your buy now, pay laters and credit cards. And, if they don't teach you this stuff at school, like how does this stuff work? It's so easy to get credit. And through these lessons, you learn, actually, I probably shouldn't have taken out that personal loan. I probably shouldn't have taken out too many credit cards, but I should have invested in property earlier when I was younger. So that's what I like to share as well.
It's a fascinating thing, I guess, Victor. One of my regular contributors to Dollars Making Sense is Philippa Hunt, who does a lot of education with women, largely single women over the age of 55, because unfortunately that's the biggest age group of people getting themselves into trouble. But certainly a lot of youngsters are getting themselves into a lot of trouble because of things like buy now, pay later. And I guess that's one of the reasons I wanted to bring you on the show to talk about that, because we talk about money around our dinner table, but you're absolutely right. When we've gone and approached our local schools to talk about finance, the curriculum's very full and it doesn't get taught at school. So how are youngsters picking up their information about what is good debt and bad debt?
It's a good question because I don't consider myself a youngster anymore. But
it's a matter of context, Victor. It's context.
But what I've heard is a lot of them are watching TikTok videos, YouTube, Instagram, and as you said, a lot of the finfluencers, right? Financial influencers. So I don't consider myself a financial influencer. I am an Australian credit license holder. I do have a mortgage broking and commercial broking business. But at the same time, I'm also a consumer. And I'm an investor. So I like to share from both sides of the spectrum, from borrowing and also from investing, and also from what my clients do in a sort of a optimized and an effective, tax effective way. So podcast is probably, a great medium to do that. I have my own podcast as well, which I share a lot of these insights. But the banks really, unfortunately, and the financial institutions, they're earning interest on and charging you fees, but they're typically not going to educate you on how to optimize it for your own benefit, right? They'd probably prefer you carry the debt for as long as possible.
it's one of those fascinating things. I can actually speak as the voice of experience that I can remember back in the day in 1978 when Bank Card first came out, and this was before you were born, Victor. And so from that perspective, when Bank Card came out, MasterCard and Visa were overseas brands, and American Express and Japanese Credit Bureau, JCB, as other people might know it, or Diners, were all international brands, but not here in Australia. And so when Bank Card came out, this was a credit card that was pushed out by the big four major banks. And I grabbed one. I thought, beauty, let's go. And in the space of 12 to 18 months, Australians racked up some enormous amount of debt because they gave these to everybody. And, when we dial the clock forward, there doesn't seem to be that much restraint even now, given all those years of experience. Is that your experience as well, Victor?
Yeah, exactly. I mean, when I was 18, I was working in retail at Coles, and I wanted to buy a car. And I walked into my bank, which was St. George Bank at the time, and they approved me, and I was on a casual income. They approved me $8,000 credit card, and they also approved me for a it was a $5,000 credit card and an $8,000 personal loan straight on the spot. So it was easy to get money, and it's gotten easier. And then they entice you with limit increases. So I went through that cycle where I was like, oh wow, they've given me a limit increase. So it felt good. So I took it. And at one point I even had 5 credit cards.
Five.
Five credit cards,
Wow.
yes. Yeah. And I was going through the experience working for a financial institution. So I was learning, both ends. I did realize over time that 5 credit cards or more credit cards is not actually a positive thing. But at the time, it felt like it was. I was like, wow, I've got access to all this credit. And so, yeah, look, that was from the personal side of things. And then, buy now, pay later has only sort of come out the last few years. And I can personally attest that I've never used it. I've had clients that have had them and closed them in order to get their mortgage applications across the line. But
yeah, we'll talk about that. We'll pick up on that in the second half of the show. But I think what's fascinating for me is that over the years, when Bank Card first came out, access to the card was free. Mind you, banking services back then did not have the kind of fees. You could open a bank account at that time and not be levied the kind of fees and charges that we are today. And so gradually over a course of time, the big four have certainly made their claim, stake their claim to how much fees they make from all of us on a daily and yearly basis. But I think, the idea of having 5 credit cards when I think the average fee for a card is anywhere between $50 to $200 per card. All of a sudden, those kind of costs can be quite prohibitive. And so that, together with the vast majority of credit cards that I'm aware of, and please, tell me if I'm wrong, but that money costs anywhere between 20 to 24%. When rates, home loan rates right now are around the 7s and 8s, and so that's triple the cost of what a home loan. And I might remind ladies and gentlemen as well, during the pandemic when interest rates were at record lows, and the RBA was at 0.1%, credit cards were still at 24%. So I'm just sitting there going, somebody's making a killing.
Yeah. No, it's true. You don't realize what you're actually paying in interest. What I can't remember what year it was, but there was some legislation that basically said that on the statements, the financial institutions that offer credit cards, the banks, actually have to disclose how long it will take you to pay the credit card off if you made the minimum payment. But when I was getting credit cards, that wasn't on the statement. So you make the minimum, and literally it's just it's interest and maybe a very small percentage of principal. And it can take 15, 20 years sometimes to pay back 10 grand. It's ridiculous. So
it takes my breath away just hearing those numbers, because I think, and I've come across, I as somebody in finance, thankfully, I guess from my perspective, I don't deal with day-to-day punters when it comes to this, but I've been asked by members of my direct and indirect family sometimes to step in and help. And I mean, you've probably seen this yourself, Victor. You see some tragic errors. And, when you've got 5 credit cards, I've seen people use credit cards to pay off other credit cards. And so they're what's called the debt rollover. So they're rolling debt over with more debt, which is just, I want to scream, because you are paying so much money in interest that it's just frightening when you think about it, really.
Well, that's exactly how I got to 5 credit cards. So,
Oh, really? So you
yeah,
were in that trap?
I was in that trap. So the way they get you, and it does work if you do it right. So what happens is you do what's called a balance transfer. So you
Ah,
apply for one credit card to pay out the other. But then what happens is that bank doesn't pay the other credit card out directly. So sometimes they actually pay you, and then therefore you have access to cheap money potentially. That's what happened
so
to
they
me,
give you the cash?
to pay the card, hoping that I'll actually do it.
Oh, no. I thought that went directly on the card, that you had no choice.
Maybe now, but at the time it wasn't the case. They literally gave me a
No
bank check in my
way.
name and I could just go spend it. Look, I'll be honest, I did pay it towards the card. That wasn't the issue. I did honor that.
Oh,
But I
no.
can see where many people wouldn't, because they're tempted to use that money, right?
That's like
And
giving heroin to a junkie, isn't it?
and on top of that, they can't control whether you close the card. So therefore, exactly what happens. Say you got 5,000 owing, you apply for another 5,000, you pay out the other card, and you honor that, right? Or they pay it directly. They can't enforce you closing that card. So now you've got one
Oh,
that's free with 5,000 available, and another one that's maxed out. So if you don't close the other one, I've got 2 cards. You see, that's how it can quickly get to 5.
wow.
Yeah.
Wow. It's fascinating, I guess, because in that regard, when I helped somebody in my family using one of these balance transfer facilities, I read the PDS. I'm one of these anal people. I read terms and conditions, and I read the terms and conditions of this particular transfer. And ladies and gents, it's all well and good, but once you actually use the card, that the new one they've given you, when you pay that off, all the money you've taken for the cash to help pay the other one then starts accruing interest as well. And it's a nasty trap. And when I read the terms and conditions, I grabbed the card from my family member and cut it up on the spot, and we just used the cash and paid it off. But look, we're about time for a break here on Dollars and Making Sense. I have Victor Lagos from Lagos Financial. We're going to go for a short break, and we'll be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson. At the microphone this week, we have Victor Lagos, not Lagos, like I said before the break. I apologise, Victor. I've got to get names right. Names are your most important thing, ladies and gents. It's something that I've had drummed into me. Get the name right. So it's Victor Lagos. So, Victor, before we went to the break, we were talking about credit rollover being such a burden on people. And when I think about young kids today, they've got HECS debt, which is what we didn't have when we were growing up. So you've got HECS debt. People then potentially get credit card debt. They're rolling over credit. And then along comes this tsunami of buy now, pay later. And we normally don't mention company names, but I'm going to mention a few: Afterpay, ZipPay, and there's another of others. There's again, there's a fair bit of credit out there. Latitude is a big company doing a lot of advertising. So Victor, what's your big suggestion then? What's your takeaway for people listening today to not get caught by these traps?
Okay. So the temptation is, and the ease is, and the convenience is what makes buy now, pay later work. So if you look at spending, say, $500 on something, and you have money in your bank account to cover that, and they say, you know what, you can actually pay this off in 6 installments instead, and oh, you know what, I only have to spend $83, therefore I can keep my 500 or 400. And so it's like, why not just do that? I can see that that's the reason what people will go for it. But
Mhm.
what you don't realize is that you're actually stealing from your future self instead of giving to your future self. See, that's the concept that got me.
That's okay.
Yeah.
I like that. I like
Yeah.
that.
Because think about it, stealing from
Stealing
your future.
from yourself.
Because think about this, you buy it and you have the feeling that it feels good. Let's just say you're buying a new mobile outright, and you get the new mobile phone, and then after about a week, you got used to it. Feels all right. Now you're used to it, just like your previous phone, right? So you've enjoyed that feeling, but now your future self has to pay it back. So for the next 6 installments, or if it's on a credit card, however long it takes you to pay it back, now you have to pay it back while your past self got to enjoy that. While your future self is like, oh, thanks, past self. Now I got to deal with this, right? Because now it's affecting your pay packet in the future, no longer the past pay. It's not like you put money aside dedicated for that, right? It's going to come out of your next pay packet and maybe the one after that too. But and if you think about it from the other way around, that's what's called instant gratification. If you have what's called delayed gratification, the other way around is giving to your future self. So if you don't want to part ways with your $500 right now, then
Mm.
put away $83 per week, per fortnight, however how often you get paid. And then each time you do that, it feels good because you know that you're putting money aside and you're going to give to your future self, and you're managing your money. You're actually, in
In
control of it.
control, yeah, very much
Exactly.
so. So it's very much. There used to be a cartoon that I remember growing up where you had a little devil and a little angel on either shoulder, and the devil was talking in one ear and the angel in the other. And I guess it's very easy when you think about what's transpired over the last sort of 4 to 5 years with the pandemic, with the increased payments, with people, I guess, with a lot of time on their hands. And I know internet spending went through the roof, as did internet gambling, which, again, these are things that I look at, and these are disasters waiting to happen when you are trying to create wealth. And I'm not trying to be a Debbie Downer here, Victor, because I'm a huge believer in self-responsibility. And also, if you're out there and you've worked hard, you've got every right to spend your money the way you want. That's what freedom of choice is. The difficulty becomes, as you've rightly pointed out, if you're stealing from yourself and then your future self's looking back. I mean, these are tough things to really start, thinking about. And I've seen buy now, pay later now extending into even meals where you go out to dinner, and I've seen restaurants that actually BNPL a $150 dinner out. All of a sudden, you're still paying for that 6 weeks later. I mean, that really nice pizza restaurant you went to, that tastes long gone.
Exactly. That's right. And the other thing is, if you're doing it more often than not and multiple providers, or multiple little contracts, what you're actually doing is enforcing that idea of instant gratification, and therefore you're not thinking about the future. And then when you're saying, I want to now buy a house or I want to invest in property, well, you need to now work hard to train your brain to actually put money aside, because you need a significant deposit now. But you're used to getting
You're
what
not
you want
wrong.
right now without your money, so you're on the back foot. But if you start training yourself, putting money aside each paycheck, eventually you do have enough to pay that mobile outright. You thank your past self and say, "Thank you for putting money away. You look after me," and now you own the phone outright. So you have that positive feeling moving forward.
Now, Victor, I wanted to ask you a more in-depth question. You mentioned in the first half of the show that you've been talking to some of your clients who've had to get rid of their BNPL when they're applying for a loan. Now, I've heard these stories as well, that credit cards and BNPL accounts can actually be a big detractor. So, as a mortgage broker, what do you advise people that walk into your office and say to you, "Hey, Victor, I want to take out a loan," and they've got these, maybe even if they don't have debt, but if they've still got a credit card, that could be a problem, couldn't it?
Yeah, so banks will always look at the worst case scenario. And that is if you decided to max out your buy now, pay laters up to their limit and max out your credit cards. So many clients tell me, oh, I clear it every single month or I pay it every single time. So the bank should only look at that. I said, no, no, no. They don't look at that. They look at what's the worst case scenario. So sometimes people are carrying really high limits. You know, they have a Zip Pay account for 5 or 10,000. So if they can bring that down to $1,000 or, even better, close it, that's going to improve their borrowing capacity. And it's also going to make them look better to the bank because they've, closed that. So now that's showing on their credit file as closed. That improves your credit score. See, people have the misconception that, oh, I need to have debt in order to improve my credit score. No, you literally just have to have a credit file and make your, and never fall into default. Make your payments, and that's it. That's enough to get your credit score. It will get better over time as you age, and then when you take out a mortgage and you make those payments, it'll improve too. So yeah, that's also a misconception out there.
I guess another misconception, and again, correct me if I'm wrong, because you see this day by day. I don't. Is it true that the banks are now looking at what's on your credit card and how many coffees you're having on a weekly basis? Is that true?
It's a good question, actually, right? So some banks, yes. So through,
no,
yep, they will.
When should that be any of their business? Hey, I'm Italian. I like my coffee. I mean, if they're going to tell me I can't have my coffee, it's like, hang on a moment, guys.
What they do is they look at your transaction history, including your credit cards, and they work out what did you actually spend in the full month versus what you declared. And they have a measure called HEM, Household Expenditure Measure. All the banks use it. It comes from the Melbourne Institute. And this is an estimation of what a household would spend based on how much income you're earning, based on your location, based on how many in the household. And that's the minimum. But if you declare that you spend less than that, they're still going to use that as their minimum. But if you declare less and then they check your credit cards and your transactional statement and it adds up to average out more than what you've declared, they're going to ask the question and say, wait a minute, aren't you actually spending more? Because your cards are showing that you are.
Wow.
Yeah, for sure. But look, not all banks will ask for that. And this is where it's my job as a broker to find the banks that actually are a bit more, realistic. Because let's face it, when people take out loans to buy property, they're usually going to also adjust their spending, right? They're not going to always go out every single night. They're going to adjust it because they're taking on a new debt. So that's the other thing it doesn't account for.
I've got to tell you, it would be a very interesting thing for people my age, and I'm considered a boomer, although I still think I'm a little young in that space. But when we were going for our mortgages, I actually borrowed money from the bank of mum and dad because back then, if you didn't have a long-standing relationship with a bank, they wouldn't lend to you. I mean, these days you can turn up to any bank. They may not know you from Jack, but they'll still lend you money if you pass all the tests that you've been talking about. But I guess it's a fascinating thing because, again, people my age say, oh, the kids don't know, we had to go through 18, 19%. And that's a fair cop. That's a fair comment. But the real difficulty these days is that the average cost of a house now, for example, here in Sydney and even in Melbourne and many other regional centres where this show is taken and listened to, is not 2 or 3 times when I was in my 20s. It's 10 to 12 times. And so, you are talking to people on a daily basis. What kind of deposit are people walking into your office and saying, hi, we're ready to buy a place?
Well, if it's for an owner-occupier buying their first home, I'm talking to one, for example, looking at buying in Sydney for 650,000, which is very difficult to find. That's a unit in most places. And she has a deposit of 135,000. That's with stamp duty waived, right? Because as a first-time buyer, you have stamp duty
first-time buyer, of course. Yes.
Correct. But if you don't have the stamp duty waived because you've owned property before, or you're buying an investment interstate, then you would need upwards of 150,000 to cover the deposit, and that's to avoid lender's mortgage insurance. So, and have a competitive interest rate. All right. So that's Go on.
Now, before we finish up, because Victor, I'm definitely going to have you back on the show. Can you please explain to me, when people have to take out mortgage insurance, who is that insurance actually covering?
Yeah, so it's called LMI, Lender's Mortgage Insurance, and it's actually there to protect the bank, not the actual borrower. It's so that
big misconception, isn't it?
Misconception, yeah. And another misconception is that you can switch banks. So people will say you go in at 90% in loan to value ratio and you pay, lender's mortgage insurance. If you then decide to refinance and go to another bank, if that's still at 90% or 85% because the value's gone up slightly, you now need to pay LMI again with another bank, even if it's the same mortgage insurer. They'll still
Oh,
charge you again. So they're double dipping because it's a different bank you're going with or a lending institution,
wow.
and you don't get a refund either. So it's it can be quite costly. So if you can avoid it, the better. Other times, if it's a cost of doing business and you're building wealth through property, it's a strategy. It's also tax deductible. But when you're moving into your first home or an owner occupied property, if you can get that to 80% or below, it's going to give you better options, and it's going to allow you to switch banks later in the case that you need to get a better rate.
And I might add, ladies and gents, if you're listening, it wasn't overly common in my time. We didn't go out and buy a home straight off. We bought an apartment. I mean, when I was going out to buy my very first property when I got out of the Defence Forces, there was no way known I could afford a house. I mean, that was just way out of my league. And so, buying an apartment was always, in my view, that first rung on the real estate property merry-go-round that I remember I hopped on it, I think, at the ripe old age of 28 or 29, but thankfully stayed on it ever since. But, Victor, look, there's so many things we can be talking about. And I mean, the little cheat sheet you sent me is some great topics. And I really like, one of the key takeaways I want people to think about is gifting themselves and stealing from themselves. That's a great message that I think we can leave our listeners. And Victor Lagos from Lagos
Financial.
from Lagos Financial. It's been a real pleasure having you on the show.
Thanks, Ray. I really appreciate it. And if those who you want to listen to my content, you don't even have to be my customers. I also have my own podcast. It's called Debt to Financial Freedom, and you'll find that on Spotify and YouTube and whatnot. So
wonderful. Happy to give it a big plug. Good education out there, ladies and gentlemen. Good financial education. Remember, save for yourself, not for the banks.
Don't steal from yourself. Give to your future self.
Absolutely. Victor Lagos, thank you so kindly for your time today.
No worries at all. Thanks, Ray. Thanks for having me on. Appreciate it.